Snowflake is one of those companies that tech investors either get super excited about or completely avoid. It's a big player in the world of cloud data, a space that's not only massive, but growing fast. The company calls itself the AI Data Cloud Company, and if you've ever wondered what that actually means, we're going to break it all down. In this video, we'll cover what Snowflake does, how their latest earnings looked, where their growth could come from, the risks they're facing, and my own personal move with the stock. I'm not here to hype it up or trash it, just to give you the full picture so you can make your own informed decision. So let's start with the basics. Snowflake isn't a typical database company. Traditional databases are often tied to specific hardware or cloud providers, but Snowflake was built entirely for the cloud from day one. This gives it some huge advantages. It's more flexible, it scales better, and it's designed to separate compute from storage. If you're not deep into the tech jargon, here's what that means. Storage is where your data sits, and compute is the processing power needed to work with that data. Snowflake lets customers scale each one independently. So if you have a ton of data but don't need a lot of processing, you don't overpay, and vice versa. This setup is especially valuable for big enterprises, which can have unpredictable data usage patterns. And Snowflake doesn't just store data. It lets companies run analytics, share data securely, and now even integrate AI models right into the workflow. They've got over 11,000 customers right now, including huge names like Adobe, Capital One, and a bunch of Fortune 500 and Forbes Global 2000 companies. Now let's get into the latest earnings, Q1 of fiscal 2026, ending April 30th, 2025. Snowflake brought in $1.0 billion in total revenue for the quarter, up 26% year over year. Most of that came from product revenue, $996.8 million, which was also up 26%. One of the most important metrics to look at with Snowflake is the net revenue retention rate. That's basically how much more existing customers are spending compared to last year. Snowflake's NRR came in at 124%. This means their current customers are spending 24% more than they did a year ago. That's a sign of a sticky product that grows with its clients. They now have 606 customers generating over $1 million in trailing 12-month product revenue. That's up 27% from last year. And they're working with 754 Forbes Global 2000 companies, which is 4% growth year over year. These are the kinds of customers with big ongoing budgets. Remaining performance obligations, which is essentially contracted revenue for the future, hit $6.7 billion, up 34% year over year. That's a huge backlog and a strong signal of demand. So why are these metrics important? For one, high net retention means Snowflake doesn't have to constantly fight to replace churned customers. They can grow just by expanding inside existing accounts. The growth in million-dollar customers is also big because large enterprises tend to stick around for years once they're integrated. And that backlog of $6.7 billion, it's like having a multi-year line of sight into future revenue, which helps de-risk the business a bit. Of course, they still have to deliver, but it's a strong position to be in. Looking forward, the cloud data market is massive and still expanding. Every industry, from finance to healthcare to retail, is collecting and analyzing more data than ever before. On top of that, AI is making data even more valuable. You can't really leverage AI effectively without a strong, clean, and scalable data infrastructure. And that's where Snowflake fits in. They're not just sitting still either. They're expanding internationally, launching new features, and pushing deeper into AI integrations so customers can train and run models directly on their data. If that takes off, it could become a major revenue driver over the next few years. But we have to talk about the risks. First up, competition. Snowflake isn't competing with small players. They're going up against giants like Amazon with Redshift, Microsoft with Azure Synapse, and Google with BigQuery. These companies have massive resources, huge customer bases, and can bundle services in ways that Snowflake can't. Then there's profitability. Snowflake is still not consistently profitable. They're plowing a lot of money into sales, marketing, and R&D to fuel growth, which means their bottom line is still negative. If growth slows, that could spook investors fast. There's also the reality that cloud infrastructure costs can change. If those costs go up and Snowflake can't pass them along to customers, it could pressure margins. Finally, data regulations and privacy laws are evolving quickly. If governments start restricting how and where data can be stored or shared, it could create friction for global operations. So here's where I land on Snowflake. It's a company with a unique architecture, a strong customer base, and a big growth runway in both cloud data and AI. They're clearly executing well based on the latest numbers, and the market they're in isn't going away anytime soon. But competition is fierce, profitability isn't here yet, and valuations for high growth tech stocks can swing wildly. For me personally, I'm going to hold on to my position until Snowflake reports Q2 earnings later this month on August 27th. I want to see how the company performs before deciding whether to lock in some gains. That said, I'm still keeping an open mind. Depending on the results and market reaction, I may trade it again in the future if the setup looks right. That's the full picture on Snowflake. A balanced look at where they stand today, where they could go, and what could hold them back. Thanks for watching. See you in the next one.